Hey guys, welcome to my summary video on market interventions and how surplus gets redistributed and the inefficiencies of meddling in a competitive market. I've got videos for each of these other topics on here. I'm not going to go into big detail on what these all mean. Look earlier in my playlist or search around my channel. But in any case, I'm going to be showing the consumer surplus, producer surplus, tax revenue, and deadweight loss from each of them by shading them on the graph. And we'll discuss a little bit of what's happening. So first, let's look at equilibrium. In equilibrium, every mutually beneficial transaction occurs. That means it's efficient. That's one of the things we like about competitive markets is the efficient outcome. Every good thing that can happen does happen. And then consumers, everything below their willingness to pay on the demand curve, but above price, is excess dollars in their pocket. We measure it as consumer surplus. Producers, everything below their price but above their opportunity cost of production is extra willingness to sell, is producer surplus, which is a lot like profit. But again, remember, it ignores fixed costs, so it's not the same thing. So there you have it. There's the efficient equilibrium outcome. Now, a price floor is something like this, where we prop up prices and say they're not allowed to fall below a certain point. When we do that, it decreases the quantity demanded because the price is now higher than it used to be. I could mark quantity supplied on there, but it doesn't actually matter for the purposes of showing who gets how much surplus, because the lower of the two quantities is what chooses how many transactions happen in a market. So in this situation, what do the surpluses look like? Well, there is the consumer surplus below demand, above price. Price is high, so they don't buy as many, and they buy at a higher price. That's a lot less surplus. Producer surplus is everything below price, above supply, up until the quantity of goods that actually gets sold. And so you'll notice that producers will actually capture some of what demanders would have gained, but now that the price is too high, it's been transferred to the producers. But you'll also notice that because fewer transactions happen, there is a loss of surplus in our market, which we call a deadweight loss. Price ceilings behave very similarly. They hold the price down, preventing it from rising, and that pushes the quantity supplied to some lower level. Again, I could trace the quantity demanded over here to measure the shortage, but it doesn't matter for measuring these consumer and producer surpluses. I do need to take this quantity all the way up to the demand curve, though, in order to do what we're about to do. So let's take a look at what happens in this market now. When you hold the price down, sellers will sell less at a lower price, and their producer surplus will decrease. When you hold the price down, the ones who buy the good will benefit because the price is lower. Everything below this point in here would have been producer surplus in equilibrium, but now is not. But again, the fact that there is a lower QS than Q star means that we're going to miss some mutually beneficial transactions, which is our deadweight loss. Quotas. A quota is when you fix your quantity of a good and it cannot exceed a certain amount. Now, when we fix the quantity to some lower quantity, we usually assume that means that the price is going to rise up to the demand curve. And what does this do to surpluses in our market? Well, this is actually going to look a lot like the price floor, because quotas, like price floors, are often intended to benefit the sellers. So there's some sort of a transfer from buyer to seller, but of course there's still also our trusty friend, the deadweight loss, who is always there whenever we try to meddle in a competitive, efficient market. Now, with our excise taxes, I know we can draw it by decreasing the supply curve if the tax is on suppliers, or decreasing the demand curve if the tax is on demanders. I'm going to do it just by drawing the wedge in between. There is a gap between the price consumers pay and the price sellers receive, and that gap is the tax itself and how much the government is collecting. So when there's a gap between the prices, that means that there's a demand price and a supply price, and they receive a different amount. The gap between them is the tax that the government actually collects. And so when we go to measure our consumer and producer surpluses, consumer surplus gets everything below demand, above demand price. Producer surplus is everything below supply price above the supply curve. This becomes tax revenue. The certain number of dollars high, the tax dollars high, times the quantity sold in our market. And of course, the taxes, because they decrease the quantity sold, still create a deadweight loss. And so we can see these patterns of redistribution, but the biggest pattern I see is that all of these interactions between government and efficient markets make the market less efficient and create deadweight loss. Side note, later on in your class, you'll probably learn about some exceptions where markets start as inefficient and government correction could reduce the deadweight loss, but that's not for this video. One thing I also want to point out, whenever there's a deadweight loss, whenever the quantity in your market that is actually happening is different from equilibrium, that means that there are mutually beneficial transactions that are not allowed to occur. There are transactions where buyers want to buy it and sellers want to sell it, and they all can agree on a price. And that's why there's deadweight loss. That's called inefficient. But that can often lead to the presence of illegal markets, or black markets as they're often called. In a black market, what happens is buyers and sellers meet together illegally. In a price floor, it could be sellers who are willing to sell for less than the price floor, as long as it means that they actually get to join the market between QD and Q star. In a price ceiling, like something like rent control, it could be that although the price is low, some people might be willing to pay their landlord more to be able to get an apartment instead of being stuck in this dead zone between QS and Q star and not being able to get an apartment. In the case of a quota, it just means that there are extra market activities that aren't allowed. Where quotas are often about licenses or quantity limits, it would just be people working without a license or something like that. In the case of a tax, there were people willing to work under the table to avoid the tax. These illegal markets are often a byproduct of these market interventions, just because they create inefficiency, which, if the inefficiency is big enough, means there's a lot of money still to be made. So they don't have to happen, but they often do. Anyway, I hope that this was somewhat helpful to see them all on the same page. If not, too bad. But yeah, hopefully. Anyway, if this was helpful, maybe you can like it or subscribe or whatever. But if not, whatever. Good luck econing, guys. Thanks for watching, and see you next time.